We are live, and if you're listening to this right now, I need you to understand something. The clock isn't ticking down on a holiday. It's ticking down on one of the biggest, most consequential financial shifts that's hiding in plain sight. And if you are not ready for it, you are going to pay. And I mean, you are going to pay in actual dollars right out of your paycheck.
You're absolutely right. December 31st is not just the end of the year. For anyone who's serious about their money, it is the line in the sand. It's the difference between keeping what you earn and just unnecessarily handing it over to Uncle Sam. We're talking about the massive shift that's coming when President Trump's 2017 Tax Cuts and Jobs Act, well, when those provisions expire, it's going to flip the entire U.S. tax code on its head starting January 1st, 2026.
And this isn't some, theoretical debate for accountants. This is the biggest wealth repositioning event since 2017. And the shocker, the absolute outrage of it all, is the knowledge gap. The people who already have the money, the high net worth individuals, the big business owners, they know this date is lethal. They are already restructuring their portfolios, delaying invoices, shifting massive streams of income.
And here's the core devastating fact that just shows you how unbalanced this is. The IRS didn't hold a press conference. They didn't issue some big public service announcement. No, they quietly released the new 2026 tax bracket changes in a silent, almost hidden filing on their website. It was basically an admission that the thresholds for every single major bracket are shifting for the better, and they just let the people with high-priced advisors find the information first.
A quiet filing. I mean, that's the very definition of rigging the game. No headlines, just a silent signal that starting in a few weeks, the entire tax structure becomes more forgiving. We're going to be able to earn way more money before we get bumped into a higher tax rate, but, and this is the deadly but, only if we wait. The people who saw that quiet filing, they've already locked in a massive, totally legal financial advantage. The rest of us are playing catch up with just days left on the calendar.
And what's so fascinating is that this quiet move immediately created a clear mathematical reason to play games with the calendar. The high-level advisors saw that door crack open, and now they're moving with surgical precision across all their clients' books. They're systematically delaying any income they can. They're restructuring payouts because they know the second January 1st hits, the savings are significant. And those savings, well, they add up to fortunes at scale.
We have, maybe 28 days left to use this information. Stay with us as we expose the full truth right here on The Deep Dive. If you want the news they don't want you to hear, hit that subscribe button right now.
Okay, let's really unpack this. Let's get into the nuts and bolts of why these last few days of December are so financially toxic for any new income. This is critical for every freelancer, every business owner, anyone expecting a year-end bonus.
We're calling it the Great Income Delay. So, explain the immediate consequence. Why is earning $1 today, right now, so poisonous compared to earning that exact same dollar in, say, mid-January?
It's just pure structural mathematics. Right now, we're living under the rules of the 2017 law, adjusted for 2025 inflation. And in this current year, the structure is tighter, the bracket ceilings are compressed, which means your income hits those higher tax rates much, much faster than it will next year. So every single dollar you earn this month, in December, gets taxed under the absolute harshest, least forgiving rules of 2025.
So we're literally paying a premium just for the date on the calendar. If I land a big consulting fee this week, or get a surprise bonus, it gets taxed harder than if that same money hits my bank account in January. Can you, quantify that? Give us a real-world scenario.
Absolutely. Let's look at the mechanism here, which is the bracket expansion. Now, take a married couple filing jointly. Let's say their taxable income for 2025 is sitting at around $250,000. Any extra income they earn in December? That falls squarely into the 24% marginal bracket.
24%, which is already pretty high.
It is. Now let's fast forward to 2026. Because the old rules are sunsetting and we have new inflation adjustments, that 24% bracket floor is going to be significantly higher. So that same couple with the exact same base income might find that what was taxed at 24% is now taxed at, say, the 22% bracket. Or maybe the 24% bracket itself doesn't even start until you've earned another $20,000 or $30,000. It means the last dollar earned in 2025 could cost you 24 cents in tax, while the first dollar you earn in 2026 might only cost 22 cents on a $50,000 bonus. Delaying it could easily save that couple $1,000 or $2,000 just in federal tax.
Wait, hold on a second. That is the frustrating core of this whole thing. We're talking about thousands of dollars in difference just because of a change the IRS tried to keep quiet. So, okay, if 2026 is mathematically cheaper, then it's absolutely critical to delay income. But how? How does a regular person or a small business owner actually do that?
Well, that's the playbook that the sophisticated advisors are running right now. They are legally doing everything in their power to push taxable events into 2026. And this isn't just for, huge corporations. It's for anyone who has some control over their revenue stream.
Give me specifics. What kind of income streams can you actually manipulate with this surgical precision?
Think about anything that could be timed with a simple invoice or a negotiation. First, delaying in invoices. If you're a consultant, a designer, any professional service provider, just sending an invoice on January 1st instead of December 30th can change the year the income is recognized for taxes. It's that simple. Second, commission checks. Salespeople especially can often negotiate the date a final commission check is actually processed and released. A check cut on January 3rd versus December 27th falls under the new, better rules. Then you have contractual payouts. If you have big project milestones, postponing that final sign-off until the new year pushes the liability. And finally, business distributions. This one is huge for owners of S-Corp or LLCs. They literally control when they take profit draws. Pushing that big year-end distribution into Q1 of 2026 guarantees it gets taxed under the wider, friendlier brackets.
I see the strategy now. Every single day that passes locks in more income under these tighter 2025 rules. December 31st is the hard stop. It's the wall between taking a guaranteed loss, a higher tax bill, and securing a massive advantage. So if I'm a freelance writer and I finish a huge project on, say, December 20th, I should be calling my client and saying, please, whatever you do not hit send on that wire transfer until January 2nd.
Precisely. It's all about recognizing that your paycheck date, or the date the income is what they call constructively received, that determines the rulebook you have to play by. The informed taxpayer has systems that track this down to the penny, telling them exactly which payments to hold and which invoices to issue later. They are strategically suppressing their income this month for one reason. 2026 is mathematically cheaper.
Okay, let's pivot to the value add here. If every smart business owner and high-income earner is actively trying to push revenue into next year, isn't that going to create a really distorted picture of the economy? I mean, we're talking about a manufactured weakness, right?
That's a really important question, and it's something that institutional investors and economists, frankly, need to be extremely wary of. If you connect this deliberate strategic delay of income to the bigger picture, this behavior creates an intentional and a tactical financial slowdown in the reported earnings for December 2025.
So we're going to see year-end financial reports that look weaker than they actually are. Corporate cash flow might seem sluggish. Q4 GDP could be lower than it should be, all because money is just sitting in client accounts instead of being invoiced and paid.
Exactly. A manufactured weakness in Q4 2025. And then the moment January 1st hits, you're going to see a sharp, almost misleading spike in revenue reporting across the board. It'll look like an avalanche in new revenue. But that cash didn't just appear out of nowhere. It was just held back for optimal tax placement. This completely distorts year-end financial reporting. It makes the usual month-to-month and quarter-to-quarter comparisons totally unreliable, and it could even lead to, well, serious misinterpretations of economic health.
But isn't that an overstatement? I mean, it's just timing. It affects tax revenue, sure. But is the scale really big enough to trick economists into thinking the whole economy just collapsed for a month?
That's a fair point about scale. And no, it doesn't stop the fundamental work from getting done, but it has a huge impact on the reporting. Think about the cumulative effect across millions of S-Corp and LLCs. They account for a massive chunk of private sector revenue. So when their collective year-end profit draws are all postponed, it seriously dampens the visible flow of capital. An analyst who's only looking at aggregate Q4 revenue data without understanding this tax incentive might genuinely think 2025 ended on a weak note and that Q1 2026 started with some kind of miracle boom. It's an accounting trick masquerading as an economic event.
Wow. So the informed taxpayer is basically creating a controlled micro-recession in their own books just to get a jump on the tax code. It just proves it's not always about what you earn, it's about when and how you position it.
Timing is everything, and delaying income is just the first most passive move in this whole playbook. They're also taking some very aggressive proactive steps right now.
Okay, so we know they're moving money by delaying income. But what are the, 3 non-negotiable proactive moves they're making right now before that December 31st deadline slams the door shut for 2025?
Move number 1 is what we just covered, pushing income into 2026. Move number 2 requires military precision. It's strategic tax loss harvesting. or TLH.
Tax loss harvesting. Okay, most people have heard the term sell losing stocks to offset gains. But let's get into the mechanics and the traps. How does the sophisticated version of this work?
TLH is the process of selling securities that are trading below what you paid for them, and you do it before December 31st. The main benefit is to legally wipe out any capital gains you might have realized earlier in the year, which zeroes out your tax bill on those gains. But the secondary, really powerful benefit is that if your losses are bigger than your gains, you can use up to $3,000 of that net loss to reduce your ordinary taxable income, your salary, and any loss left over can be carried forward to future years indefinitely.
So just to be clear, if I made $25,000 selling a stock in June, but I have $30,000 in paper losses sitting in my portfolio right now, I can sell those losers, wipe out the entire $25,000 gain, and then use $3,000 of the remaining loss to lower my salary income. The last $2,000 just carries forward. It's a legal way to turn a portfolio loss into a real tax win.
It's a huge opportunity that just vanishes at midnight on December 31st. But here's where it gets really interesting, and this is the trap that even experienced investors fall into every single year. It's a technicality the IRS polices ruthlessly. The 30-day wash sale rule.
Ah, the trap. So the moment I sell my losing stock, I might still love the company and want to buy it right back. What happens then?
You sell it, you capture the loss. That's step one. But the IRS is very specific here. If you buy back that exact same stock, or what they call a substantially identical security, within 30 days, either before or after the sale, the IRS just wipes the loss away. It's disqualified. It's like it never even happened for tax purposes.
So I sell my losing stock on December 20th to get the tax loss, but then I get jumpy and buy it back on December 22nd. And just like that, a $30,000 loss is completely invalidated because of a 2-day mistake. That is exactly the kind of detail that separates the prepared from the unprepared.
Exactly. And the sophistication comes in navigating that substantially identical clause. A professional advisor won't just tell you to wait 31 days. They'll implement a strategy to keep you in the market. So, for example, if you sell Apple stock at a loss, you can't buy Apple back for 30 days. But you could immediately use that money to buy, say, an S&P 500 ETF, which holds Apple, or maybe another highly correlated tech stock. This lets you stay invested in the general market trend while making sure that initial loss is 100% legitimate.
Right, so the goal isn't just to get the loss, it's to stay invested without breaking the rule. That takes real precision. And the clock is ticking, because if you sell on December 31st, you're out of the market for all of January, and you could miss a big New Year rally.
And that waiting period is the price you pay for the tax benefit. But a properly harvested loss can be worth tens of thousands in reduced taxes this year, which is crucial because, again, 2025 is the higher tax year.
Okay, let's go to move number 3. Maxing out tax-advantaged accounts. This sounds basic, right? Everyone knows to fund their 401k. But what's the sophisticated layer that makes this a critical December strategy?
Well, the basics are true. These accounts, HSAs, IRAs, 401ks, SEP IRAs, they're essential because they let you legally hide money from taxes, either now or later. Maxing them out before the year ends gives you an immediate deduction for 2025.
And why is reducing 2025 income so critical right now, especially with the 2026 changes coming? This is that double advantage you mentioned.
The double advantage is the real insight here. We know that 2026 contribution limits for these accounts are almost certainly going up because of inflation and other changes. So by maximizing the deduction you can take in the tighter 2025 environment, you're getting the biggest possible tax break right when you need it most to lower your income in this high tax year.
I see. So you're shrinking the income that's subject to the compressed higher 2025 tax rates by stuffing money into these accounts. And then when 2026 hits, you get a fresh start with new, higher contribution limits so you can shelter even more money next year.
Exactly. You are front-loading your tax savings and maximizing your shelter space. Think of it like completely filling up a shelter that's available now, knowing that a bigger, better shelter is opening up right next door in January. The sophisticated planner is doing all three of these things, delaying income, harvesting losses, and maxing out accounts all at the same time right now.
And that's it. That's how the wealth gap just quietly widens legally every single December. The average person uses none of these tools, or they trip over the wash sale rule. The informed person uses all three and legally expands their financial lead just by being better informed.
It's information arbitrage, plain and simple, executed through legal financial engineering. The difference this makes in just 28 days is immense.
Okay, let's pivot now, because it's not just about income and retirement, it's about investing and business strategy. What happens on January 1st in the investment tax world, specifically with capital gains?
The investment tax word changes dramatically. This is why high net worth individuals sitting on big appreciated assets, stocks, real estate, you name it, are holding off on selling. They're waiting for the capital gains thresholds to expand.
Okay, detail that shift for us. Which tiers are getting bigger, and what does that mean for an investor in, practical terms?
We have three main long-term capital gains tiers: 0%, 15%, and 20%. Under the new 2026 structure, all the NT thresholds for these tiers are expanding. The 0% bracket, for one, expands significantly. This lets more Americans, especially those with lower overall income, sell investments and realize profits completely tax-free up to that new higher limit. The 15% bracket is the one that widens a lot for most professionals. It allows them to realize a much larger profit before they get pushed into that top 20% tier. That's the window they're all watching. And then for the highest earners, the threshold for the 20% tier itself jumps up.
So, if I'm an investor sitting on a huge gain, let's say an investment that's gone up by $750,000, selling it before December 31st could cost me thousands more in taxes than just waiting until January 2nd. The same stock, same profit, but two totally different tax bills just based on the calendar date.
It's the ultimate timing problem. If you sell now, you lock in that gain under the old, tighter 2025 rules. That could push a bigger chunk of your profit into that 20% bracket prematurely. If you wait just a few days, those expanded brackets might keep that entire $700,000 gain mostly within the 15% tier. The savings are substantial. It's really shocking how much control the calendar has here.
Okay, that brings us to another area where business owners are just feasting right now, bonus depreciation. Tell us about this retroactive loophole that's about to slam shut.
This is a critical one. It's a major tax weapon called 100% bonus depreciation. Business owners are using it to just slash their 2025 tax liability.
What does 100% bonus depreciation actually mean for a business owner?
It means that if you buy certain qualifying business assets, you can legally write off the entire cost of that asset in the year you buy it. You don't have to depreciate it slowly over 5 or 7 years. It's immediate, massive tax relief. And the crucial deadline for making new purchases to claim that 100% deduction is December 31st.
So if I spend $100,000 on new equipment, servers, machinery, whatever, I can deduct the whole $100,000 in 2025, slashing my taxable business income by that full amount right away. That's a huge incentive to spend now.
It creates an almost irresistible incentive for businesses with cash to buy things now that they were planning to buy next year anyway. The key is the equipment has to be put into service before midnight on December 31st.
But the example that always gets people's attention is the vehicle loophole.
Yes, the infamous vehicle loophole. This deduction applies to business assets, and that includes vehicles that weigh over 6,000 pounds.
The G-Wagon, the massive pickup trucks, the big SUVs that you see influencers and small business owners driving.
Exactly. If a business owner buys one of these qualifying heavy vehicles, and it has to be used primarily for legitimate business purposes, they can often write off the entire purchase price in 2025.
That's insane. You spend, say, $120,000 on a big business vehicle, finance most of it, and then legally write off the entire purchase price, creating this giant tax deduction for 2025. But you're saying if you don't buy it and put it in service by the 31st, you lose that 100% deduction.
The rate begins to phase down in the following years. So missing the December 31st deadline means you miss the chance to get the biggest possible immediate write-off in 2025. Sophisticated owners see this as a mandatory tool for reducing income in this high tax year. They are moving heaven and earth to close these deals right now.
This is a perfect example of how the tax code creates these weird economic behaviors at year end. If you're not in the know, you just miss out. Okay, but we're not done with deductions. We have to talk about the DIF, the Donor Advised Fund.
We do. And first, we have to just dismantle a common misconception about charity. The average American thinks that every dollar they donate lowers their tax bill. For most people, that's completely false.
Right, because of the standard deduction. For 2025, it's really high, around $14,000 for single filers and $29,000 for married couples.
Correct. So if all your itemized deductions, your state taxes, mortgage interest, and your charitable gifts don't add up to more than that high standard deduction, you just take the standard deduction. Your charitable giving gives you zero tax benefit. The average person who donates $1,000 a year is doing a wonderful thing, but they're getting almost no tax benefit from it.
So enter the wealthy who have engineered this perfect workaround, the donor advised fund, or BF. How does this turn altruism into a potent tax shield?
A DF works by decoupling the tax deduction from the actual giving of the money. What sophisticated people do is a strategy called bunching their donations.
Bunching?
Yes. Instead of donating, say, $10,000 every single year, which would never get them over that $29,000 standard deduction, they'll donate $50,000 or $100,000, all in one year. In this case, 2025. That huge lump sum pushes their itemized deductions way over the threshold, letting them claim the full massive deduction in 2025.
So they get the huge tax break immediately in 2025, the year they need it most, because it's the higher tax year.
Exactly. They lock in that deduction, which significantly reduces their 2025 income. But here's the really sophisticated part. Instead of donating cash, they often donate highly appreciated stock or crypto that they've held for the long term.
Wait, why appreciated stock specifically?
It's a dual benefit, a hallmark of sophisticated planning. When you donate appreciated stock directly to a DAF, two things happen. First, you get the immediate fair market value of the stock as a tax deduction this year. And second, and this is critical, neither you nor the DAF ever has to pay capital gains tax on all that growth. You avoid the capital gains liability completely while getting a deduction for the full current value.
And that is just so powerful. They avoid the capital gains tax, get a huge deduction to shrink their income in the high tax year, all because they did it before December 31st. And the money just sits in the fund while they decide where it goes later.
They get the massive deduction this year, but they keep the power to recommend which charities get the money over the next several years. It is strategic generosity. It secures the biggest write-off in the year, it provides the most leverage the year before the brackets expand, while they maintain total flexibility.
Meanwhile, regular people donate from the heart and get almost no tax benefit because nobody taught them the rules of the game. The difference in financial trajectory these moves create in just a few weeks is terrifying.
Okay, let's zoom out and put a verdict on all of this. We are days away from January 1st, 2026. This isn't just a routine tax change. High-level economists are calling this a true redistribution moment. What does that actually mean?
And crucially, this isn't the government forcing a wealth transfer. This is voluntary. It's purely based on information and timing.
And that's exactly what's so fascinating. It's a massive voluntary wealth transfer, just amplified by timing and who has access to information. Some sources are calling this the largest driver of the wealth gap since the 2017 law itself, because the stakes are so structural. This is a moment where being strategically informed completely dictates your financial outcome.
Why is the impact so profound this time around?
It's because you have this confluence of factors all hitting at once. One, you have the scheduled sunsetting of the 2017 law, which is inherently complex. That's what's leading to the wider 2026 brackets. Two, you have concurrent high inflation adjustments that are also widening all the thresholds, making 2026 exponentially more favorable than 2025. And three, you have all this economic uncertainty, recession fears, interest rate volatility, which encourages sophisticated investors to grab every deduction they can right now.
So the informed person who moves their money before the shift is positioned perfectly to ride the wave of the more favorable 2026 code. They start the year significantly wealthier.
They ride the wave with a minimal 2025 tax liability. Everyone else who hesitates, who just assumes January will be the same as December, they move their money after the shift and they pay the price. A higher marginal tax rate on the exact same income. The gap just gets wider and wider.
2025 isn't just another tax year. It's a defining year for positioning yourself financially, and I think that needs to be the final warning here. What does January 1st, 2026 at 12:01 a.m. look like for the two Americas we're defining?
On day zero, the financial difference between the prepared and the unprepared will be permanent, all based on decisions made in these last few weeks.
Tell us about America One, the prepared, the ones who execute.
America One is a group that acted. They executed the great income delay. They booked strategic tax losses, carefully avoiding the wash sale rule. They used the high leverage deductions the IRS doesn't advertise. The DAFs with appreciated stock. The 100% bonus depreciation. They walk into 2026 stronger, financially lighter, and wealthier. Their taxable income for 2025 is minimized, and they start 2026 with a bigger playing field. They understood that timing is everything.
And then there's America Two, the majority who rely on mainstream news for these kinds of critical deadlines.
America 2 is the group that hesitated. They waited. They assumed their January paycheck would be taxed the same as their December one. They missed the deadline for bonus depreciation, so they'll pay tax on income they could have easily shielded. They might have sold a stock in December, locking in a higher capital gains rate, only to see the brackets widen just days later.
They will pay thousands more in taxes on the exact same income, simply because the date on their pay stub or their sales slip was wrong. That's the chilling realization here. Your entire near-term financial future is being determined by these last few weeks of decision-making.
It's the consequence of relying on slow, mainstream news for these subtle but critical rules. The tax year 2025 wasn't just another year, it was a fork in the road. And anyone who relied on passive information has already lost the advantage. Financial success in this context is all about execution.
That's the reality we're facing. This whole moment just reinforces that financial success is often not about what you earn, but when and how you position your assets. The IRS sent the signal, but only to those who knew where to look. And the ability to find and act on these subtle shifts is fast becoming the most valuable skill in personal finance.
It raises a really important question for you, the listener. If this trend of quiet filings and information gaps continues, if the key to success is no longer just working harder but thinking more strategically, what essential change do you need to make in your own financial approach to stay stable in the next decade? You can't afford to rely on surface-level information anymore.
Absolutely. The clock is ticking, but some of this can still be mitigated if you act right now. But I want to know what you think. Were you aware of having to wait 31 days to avoid the wash sale rule? Or the sheer size of the bonus depreciation loophole before this deep dive? Are you in a position to delay some of your income into January? Let us know your opinion in the comments below. We read every single one. I'm Alex.
And I'm Sophia. Thanks for listening to The Deep Dive.